In his best-selling book, The 7 Habits of Highly Effective People, author Stephen Covey emphasizes the importance of first knowing where you're trying to go before starting your journey, if you want to maximize your chances of meeting with success. In other words, it's important to always begin with the end in mind. In the realm of personal finance, the end goal for just about everybody is financial independence. But there's two parts to that. The first is building up the financial capital needed to eventually enable you to sustain your lifestyle without needing to actively earn an income. And the second is how you go about maximizing that financial capital when you start drawing down on it. Today, we're going to be looking back at and comparing some of the most popular strategies people have come up with over the years to maximize that capital in the drawdown phase of financial independence, as well as a few lessons I've learned while researching each of these strategies along the way. But before we get going, be sure to like this video if you haven't already, as it really does help out the channel a lot, and subscribe with notifications on for more money-related videos like this one every single week. And if you want to further support this channel, you can check out some of the links I've left in the description below, which includes a link to the investing platform M1 Finance. Get started investing for free today. So before we get into the actual comparisons, I think it'd be a good idea to quickly recap what each of these strategies we're going to be comparing do, because this series spans some dozen or so different videos over the course of nearly a year. And in my mind, I like to categorize these strategies under a few different broad umbrellas, depending on what aspect of the drawdown phase they generally try to optimize for. And I say generally try because depending on the assumptions made regarding withdrawal rates, time horizons, and other factors, there can be some crossover and overlap. The first broad category is income generation. This can either be in the form of generating a ton of income early on, or over a short time horizon, or in the form of long-term increases in buying power. The two strategies that we covered in this series that tend to fall mostly under this category would probably be the 1/n method and the variable percentage withdrawal strategy. The 1/n method is really quite simple to understand. To calculate your withdrawals, you simply insert the number of years you want your money to last you into the equation in place of n, and that'll tell you the percentage of your nest egg that you'll withdraw that year. So if you just retired and you wanted your money to last you 30 years, you'd withdraw 1/30th of your current nest egg. In year 2, you'd withdraw 1/29th of your nest egg, and so on until you withdraw whatever's left in the 30th and final year of retirement. This approach tends to produce strong income over time, since the percentage of your nest egg that you're withdrawing increases each year. The variable percentage withdrawal strategy looks at the number of years you want your money to last you and your current asset allocation to determine a withdrawal rate. This approach tends to produce strong income for similar reasons that the 1/n method does. The withdrawal rate increases as you get closer to the end of your drawdown phase, as shown in this chart. The second broad category is longevity. In other words, the primary goal is to make your money last you as long as possible. As you can imagine, doing this tends to lead to somewhat lower levels of income generation than you'd see with the 1/n method or variable percentage strategies. But for those who are retiring early or want to leave something to the next generation, these approaches can be very attractive. There are 4 strategies that we covered in this series that I feel tend to fall under this umbrella in the majority of cases. They are the fixed percentage strategy, Bob Clyatt's 95% rule, the Yale endowment approach, and Robert Shiller's variable CAPE method. The fixed percentage strategy is one of the simplest strategies to explain, because you just withdraw a certain percentage of your nest egg each year, say 4% for example. And that's really all there is to it. Bob Clyatt's 95% rule is a modification of the fixed percentage approach. Basically, you withdraw a certain percentage of your nest egg each year, but you never allow your withdrawal amounts to fall more than 5% from one year to the next. So if you decided to withdraw 4% of your savings each year, and you had a $1 million nest egg to start with, you'd withdraw $40,000 in that first year, leaving you $960,000 left over. If your investments then experienced a downturn and lost half of their value, the 95% rule would kick in. Instead of withdrawing 4% of your now $480,000 nest egg, or $19,200, like you would under the fixed percentage approach, you'd simply withdraw 95% of your prior year's withdrawal amount, which in this case would be $38,000, since that's 95% of your previous $40,000 withdrawal, and move on. As you can imagine, this does increase the risk of outliving your savings a bit compared to the fixed percentage approach, but it can also significantly stabilize your relative income levels during tough times. The Yale endowment approach is a little more complex to wrap your head around, as it incorporates adjustments for inflation, taxes, and financial guardrails, but the simplified explanation of what you do is this. Withdraw an inflation and tax-adjusted amount of money that's equal to the sum of 80% of your previous year's withdrawals and 20% of your targeted safe withdrawal rate unless that sum is outside of your financial guardrails. The standard Yale endowment strategy uses targeted safe withdrawal rates of approximately 5.25% and guardrails of 4% and 6.5% respectively. So if you had a $1 million nest egg and were using the standard figures, here's how the withdrawals could play out over a hypothetical 4-year period. As you can see, the initial withdrawal is effectively based on that targeted 5.25% safe withdrawal rate, since there's no prior withdrawals to use in the calculation. And I should mention that for the sake of brevity, I'm assuming that all money is kept in a tax-advantaged account, such as a Roth IRA or 401k, so that we don't need to worry about any complicated tax adjustments. As you can see, the sharp drop in the value of the investments in this hypothetical first year led to the guardrails kicking in and being used to figure out the withdrawal amount, at least until the markets recovered to more normal valuations. Finally, the variable CAPE method is inspired by Robert Shiller's CAPE ratio and uses the following formula to calculate its withdrawals. In the formula, A represents your fixed withdrawal percentage, B is your cyclically adjusted earnings yield multiplier, and P is the value of your current nest egg at the time you're going to make the withdrawal. One of the reasons that people like this approach so much is that it's adjusted your withdrawal amounts based on the valuations of the markets. When the markets are overvalued relative to recent norms, suggesting that a reversion to the mean could be in the cards in the near term, your withdrawals will automatically decrease, thus lowering your risk of outliving your savings. The third broad category is income stability and predictability. Strategies that fall under this umbrella tend to look to maintain the floor of your income throughout retirement, either on a nominal or inflation-adjusted basis. The approaches that we covered that I feel tend to mostly fall under this camp are the inflation-adjusted approach, or the 4% rule, Michael Keitz's ratcheting withdrawals strategy, the periodic reset strategy, and the fixed dollar strategy. The inflation-adjusted approach has you withdraw a certain percentage of your nest egg in the first year of retirement, and then adjust the withdrawal amount every year thereafter for inflation, regardless of what's going on in the markets at the time. By design, this maintains your buying power over the years. The ratcheting approach is a modification of the inflation-adjusted strategy, in the hopes of addressing the former's tendency to leave a lot of money on the table. It allows you to increase your withdrawals at a rate that's faster than inflation if certain criteria are met. Namely, if your nest egg has risen in inflation-adjusted terms by a large enough amount, and you haven't increased your withdrawals over and above inflation too recently. If those criteria are met, you would be allowed to increase your withdrawals by a certain amount over and above inflation that year, and then use that new withdrawal amount as the new baseline for your annual inflation adjustment calculations going forward. The periodic reset is also a modification to the inflation-adjusted approach. It has you withdraw the greater of your chosen safe withdrawal rate multiplied by the current value of your nest egg, or your previous year's withdrawal adjusted for inflation. And finally, the fixed dollar approach simply has you withdraw a specific dollar amount from your nest egg each and every year, regardless of what's going on in the markets. So those are the 11 strategies we'll be comparing today. Now let's take a look back and see how each stacked up in terms of income generation, risk, stability, and long-term buying power. Here are some charts ranking the different strategies in a variety of metrics relating to income generation, risk, stability, and buying power. I should note that there were a lot of strategies that tied in certain metrics, such as 4 of the 5 strategies under the maximize longevity umbrella having perfect survival ratings and never depleting their nest eggs. In those cases, I just gave each of the strategies the same ranking. So if you see duplicates, that's why. In terms of risk, we see more or less what we'd expect. The strategies in the maximize longevity category performed the best. The ones in the maximize spending category struggled the most. And the stabilization-focused approaches were generally somewhere in between. In terms of income generation, the rankings mostly flip, with the majority of longevity-focused approaches struggling this time around. When it comes to income stability, we see the spending-focused approaches outperforming longevity-focused strategies, both in terms of the frequency of income jumps and income drops. However, they both fail to avoid income drops as well as the strategies that specifically focused on maintaining a stable income floor, just as we would expect. And I should note here that the fixed dollar approach actually did outperform some strategies in terms of the frequency of income rises, not because the income changed. Remember, that strategy just has you withdraw a fixed dollar amount each year regardless of any outside factors, but because inflation was occasionally negative. So while on a nominal basis the withdrawals stayed the same using that approach, on an inflation-adjusted basis, which is how these figures were measured and ranked, the approach did see its buying power increase on some rare occasions. And just for those who are curious, here is the actual raw data for the results, including the increase or decrease in buying power as measured by the difference between the median income for the first 5 years of retirement and the median income for retirement as a whole. Feel free to pause the video if you want to examine any of these charts in more detail. With that being said, I wanted to take a minute to discuss a few things that I've learned in the course of making this mini-series. Namely, that most of the assumptions used by strategies are conservative by design, and that when it comes to planning out this stage of your financial life, it's important to keep in mind that the inputs and asset allocations you use matter a lot in determining the final outcome. And the possibilities for mixing and matching or otherwise customizing things to better help your own specific situation abound. What I mean by most assumptions being conservative by design is that achieving financial independence and or not outliving your savings is usually easier than you'd think for a variety of reasons. First, in reality, you would have, or could get, other income sources such as part-time work, social security, selling things, or starting a side hustle. Second, your budget might actually change in your favor due to lower or even non-existent transportation or work-related costs. This is something shown by the retirement spending smile that we've discussed previously on this channel, but basically it shows that for most retirees, the decrease in spending in those areas is typically enough to overcome the increase in health-related costs until much later in life, at least on an inflation-adjusted basis. Or in other words, your inflation-adjusted spending typically declines for several years in early and mid-retirement, which lowers your risk of outliving your savings in a way that most of these rules of thumb strategies don't capture. Third, you generally have greater flexibility than the strategies suggest on paper, because you could treat the withdrawal amounts produced by the strategy as a ceiling on the withdrawal, as opposed to the amount that you absolutely must withdraw for the year, which, again, lowers the risk of outliving your savings compared to what the spreadsheet is showing us. And fourth, the difference between minimum safe withdrawal rates and median and average safe withdrawal rates is pretty vast in most cases. We're talking 3 to 4% for the minimums in most cases, and about 6 to 7% for the median or averages. This alone could be enough to lower your financial independence savings target quite substantially. The inputs and assumptions we use in the formulas obviously also matter a lot because they significantly influence the outcomes. I categorize the various strategies as income-focused, longevity-focused, and stability-focused in this video. But in reality, most strategies are some mixture of the three, i.e. the strategies are being measured on a spectrum, not in binary terms. And which end of the spectrum they ultimately fall under depends heavily on the assumptions and inputs used in their calculations. For instance, the fixed percentage strategy was considered a longevity-focused one, because theoretically, you'll never run out of money using it. Basically, if your fixed percentage is anything less than 100%, you'll by definition always have something left over after your withdrawal if you follow the rule to a T. However, in reality, if you used a higher withdrawal rate, say 10 or 15%, then due to the reality of your spending floor or burn rate, you may eventually run out of money, possibly even quicker than some of the other strategies. Just to put some numbers to it, if you retired in 1992 with a $1 million nest egg using a 4% withdrawal rate and put all of your money into a simple S&P 500 index fund, you'd end up with a net worth at the start of 2022 of about $3.2 million after adjusting for inflation. However, with a 10% withdrawal rate, that ending net worth drops to around $460,000. And at 15%, we're down to about $82,000. Now, on the one hand, sure, we'd technically still have money left over in all three cases. But going into that last year of retirement, our incomes would have clocked in at around an inflation-adjusted $112,000 using the 4% rate, $43,000 using the 10% rate, and just $12,000 using the 15% rate. One might be more realistically sustainable over the long term than the others, is all I'm saying. Similarly, the 1/n method was considered an income-focused strategy due to its impressive capabilities in that area, but this assumes a 30-year time horizon, and thus an initial safe withdrawal rate of about 3.33%. Someone retiring in their early 30s, and likely having a horizon of 50, 60, maybe even 70 years, may not see the approach in the same light due to its remarkably low starting income levels, even if the income does eventually grow to substantial levels decades later. I think you get the point. The assumptions and inputs matter a lot. The same goes for the asset allocation you're using, so don't just take these figures and rankings as gospel. Depending on your own personal situation and goals, the viability and attractiveness of any number of these strategies could shift. And finally, it's important to remember that personal finance is, first and foremost, a personal thing. What works well for one person may not work well for another. Thankfully, as we've seen, there are a lot of options at your disposal when choosing how to handle the drawdown phase of your financial life. In this series, we've tackled 10 or so different approaches, but there are others out there that you can check out. And you don't even have to stop there. You can take certain ideas from a few of these different strategies, meld them together, and create your own unique approach. For example, the periodic reset approach could be supplemented with the cooldown aspect of Michael Keitz's ratcheting method, to lower the risk of outliving your savings due to too frequently stepping up your income. That's just one possible example, but my point is there are a ton of possibilities out there, so feel free to get creative and make something that'll work well for you. Because ultimately, being able to stick to your guns through thick and thin is one of the toughest, but most important, things that we can do to raise our chances of reaching financial success. But that'll do it for me today. Once again, if you enjoyed this video, be sure to smash that like button if you haven't already, subscribe, and hit that bell next to my name so you'll be notified of all my future uploads. I generally upload every single Monday, and if you have a friend that would be interested in this kind of content, be sure to share it with them. Let's really get this information out there and start our own financial revolution.